In this video, we're going to analyze the retail method of inventory valuation using Lakeside Mercantile case. So Lakeside Mercantile uses the retail method of inventory valuation. In looking at the facts, we can see basically we have some beginning inventory, and we're given both the cost amount, and I'm going to run two parallel systems here. We're going to run cost and retail. Okay, so that's the way to start these. So we have a beginning inventory, and on the cost side it's 40,000, and on the retail side it's 60,000. Okay, then they had some purchases for the year, and again under this system we look at both the cost side and the retail side. So this is after they, you see those little stickers when you go to buy something that says suggested retail price, and it's got the number on there. This is what they're using over here. Now we also have some purchase returns, and these are purchase returns. So they bought some stuff and decided they didn't want them the wrong color or whatever, and so they returned $8,000 worth of stuff to their supplier. Now, one of the things to do to get this number is we need to figure out, well, what's the markup on this? So if we take the number 292,000 and divide it by the 190,000, we get that the markup on this is about, we get this ratio, 153.68%. So what we need to do then is take this purchase return, multiply it by the 153.68%, and we get a number somewhere in the range of $12,295. And that is what we're going to use on the retail side for the purchase return. Again, we can assume, I think it's pretty safe to assume in any one period that the returns, the purchase returns are at the purchase price or the markup that we had on the purchases. Okay, so that gives us goods available for sale. Goods available for sale. On the cost side of 2,222, and then on the retail side 339,705. Now we've done these both in parallel for a while here, but now we're going to break that system. We're going to focus just on the retail side. So here's what we would have had at beginning inventory. Here were our purchases. Here's our goods available for sale. Now what a company really does track on a daily basis is their sales. So let me move this over a little bit. I'll put that right there. What they track are sales. So we're going to record the sales of this company were 280,000, and they had some sales returns. Sale returns of 14,000. So their net sales equaled 266,000. So our ending inventory at retail should be is $73,705. Okay, so now what we need to do now is convert this number back to a cost number so we can calculate an ending inventory at cost. And then if we subtract that ending inventory at cost from our goods available for sale, that will give us our cost of goods sold for the period. Now, how do we convert this back? Well, we use the same methodology that we used before. We're going to look at the cost to retail percent. So we're going to look at the 222,000 all over the 339,705. And that ratio is 65.35%. So if I multiply that ratio, that number, by the 73,705, I get a number something like 48,167. So what I've done is I've taken my numbers at retail, looked at how much my retail numbers are marked up, and then deflated them back down to get my ending inventory at cost, which is the 48,167. So I subtract these two numbers here, and I'm going to get a cost of goods sold of 173,833. So that's what I would then show on my income statement. I would show, if I was going to do a little bit of income statement in here, I'd go show sales net. I'd show the 266,000, which I got from right here, and I'd show my cost of goods sold of 173,000. Okay, and then come up with a gross profit. All right, so that's how we use the retail inventory method.